In 2026, Apple faces a pivotal moment. The company, which commanded a market capitalization frequently exceeding $3 trillion under Tim Cook, now looks toward a future under new leadership. John Ternus, slated to become the next CEO, signals a profound shift in how Apple will manage its enormous cash reserves. This isn't just a change in personnel. It's a recalibration of a financial titan's core strategy. For years, Tim Cook's tenure was defined by disciplined capital returns to shareholders, primarily through massive stock buybacks and dividends. Under Cook, Apple executed buybacks totaling hundreds of billions of dollars, effectively reducing share count and boosting earnings per share. This strategy was a cornerstone of Apple's financial success, rewarding investors handsomely and contributing to its staggering valuation. This approach, while financially sound, sometimes drew criticism for prioritizing financial engineering over aggressive, groundbreaking innovation. While Apple continued to launch successful products like new iPhones and Apple Watches, the sheer scale of its buyback program sometimes overshadowed its R&D efforts in the public eye. The balance sheet under Cook was a fortress, brimming with cash. The company consistently held over $200 billion in cash and marketable securities at its peak, a war chest that provided immense stability but also presented a perpetual question: how best to deploy it? John Ternus, currently Apple's senior vice president of hardware engineering, represents a different philosophy. His background is rooted in product development, overseeing critical hardware like the iPhone, iPad, and Mac. His ascension signals a more direct investment in the core products and future technologies. Bloomberg reports that Ternus is expected to invest cash differently, prioritizing research and development, strategic acquisitions, and potentially new product categories over the relentless pace of share repurchases. This shift is not merely cosmetic. It reflects a belief that Apple's next phase of growth demands more aggressive internal investment. One area ripe for increased investment is AI. While Apple has made strides, particularly with on-device AI capabilities and its iOS ecosystem, the market demands more. Ternus's leadership could see Apple pour significant capital into developing cutting-edge AI hardware and software, aiming to reclaim a perception of innovation leadership. This strategic pivot could mean a temporary reduction in the pace of buybacks, reallocating those billions into ventures like advanced chip development, augmented reality, or even entirely new product lines that extend beyond the current portfolio. The goal is to secure Apple's dominance for the next decade, not just optimize its stock price quarter to quarter. For investors, this transition presents a fascinating dilemma. The reliable, predictable returns of the Cook era may evolve into a riskier, but potentially more rewarding, long-term growth trajectory. The market will be watching to see if Ternus can translate increased investment into breakthrough products that justify a new, perhaps even higher, valuation. The lesson here is clear. Even the most successful companies must constantly reevaluate their core financial strategies as leadership changes and markets evolve. A strategy that served well in one era may not be sufficient for the next, particularly when the imperative shifts from capital return to groundbreaking innovation.